Okay, now I'm going to talk about LNG pricing, which is does get quite detailed, I'm afraid. LNG is not really priced like any other commodity that's traded. The unusual features it had is this the fact you have this long-term market and a short-term market at the same time. And you also have some legacy regional issues where you have gas prices in regions that are not perfectly connected. So it's not a perfectly connected global market, as you would get, for instance, in not completely, but largely something like oil, where the oil price globally, it does differ, but largely speaking, it's the same, allowing for transport wherever you go in the world. That's not the case for LNG, and that issue has caused, if you get on the wrong side of that, it can cause very, very significant difficulties and damage to commercial entities. And there are a number of examples of that happening. So I'll go through those types of pricing approaches first. So I'll start with the oldest one, oil link. And when the LNG industry initially started, one of the questions was, how do we price this stuff? Do we just make it a fixed price, or how do we do it? One of its early uses was displacing liquid fuels in power generation. So if you go, for instance, to Japan or other countries, you had at that point in the 70s, you would have had power stations running on liquid fuels. And that's not desirable, so you'd be trying to displace them with LNG. So one of the ways of kind of accommodating that was that you price it based on the fuel you're displacing. So you price it based on the oil. So the way you do that is something called the oil link. So what you do is, to get the LNG price, you multiply the oil price by some factor to get you back to the LNG price. I'll show you how that works. The sort of newer approach is that you have an LNG price, so a gas price. So you don't link it to something else. And there are a few of those around, and they tend to be regional, not global. Well, they are all regional. And there's one in Europe. And in all these regions, there's multiple indexes, but primary ones. There's one in Europe, one in the US, one in Asia. And I've written them there. Henry Hub tidal transfer in Japan, Korea market. Henry Hub is the most developed. It's very deep. It's very liquid. It's very. And as you come back this way, they get less reliable. So the tidal transfer facility in Europe again is quite well developed. And this one, the one in Asia, is unfortunately not that well developed, not as developed as it could be. So it can cause some problems. The third one is something called JLA. This is where you use Japanese customs data, and again, I'll briefly touch on this. But you look at how much gas has been landed in Japan for a month, and divide it by the cost of that gas, and you come up with something like called the Japan average, Japan landed average. So your long-term contracts have been priced on that. It tends to be quite similar to the oil link, but it's just more of an average price. The last one, cost plus with Henry Hub, which is US projects. So this is how US projects are actually structured. They're not resource projects in the sense that other LNG projects are. They're really just utility type operations. So they will take buying gas off the grid, they'll uplift it to allow for fuel and that sort of thing, transport, and then they'll just charge you a constant. And that constant is designed to cover their operating costs and pay back their debt. And because you're committed to doing that, the whole, that whole financing package works and the project gets through. And you have that facility constructed. But it's not, it doesn't expose them to the resource price. And then you have hybrids, people can come up with any sort of variation of link, sort of mixes of these sorts of pricing approaches. And that, as I said, that's where you have differences between this and other commodities, because you don't have that and that in with other commodities in quite the same way. So we just stepped through these. This is as I said, the three regional prices for gas. This top one, JKM, that's Japan, Korea, so that's Asia. So this is going back some time, back to 2010. This one is the US, this Henry Hub, and the blue one is Europe. So you can see if you go back to 2010 through to sort of 2016 or so, it used to be called the Asian premium. Stay there? Yeah, we go. So you can see, prices in Asia were significantly higher than Europe, which was significantly higher than the US. And you can see the US was really quite stable and actually reducing over the course of that decade. Towards the end, Europe and Asia have sort of started to converge, and this has continued as time goes on. And this is the phenomenon I wanted to mention, is that these two are now linked between Asia and Europe, and this has been accelerated by the Ukraine situation. And Henry Hub is completely divorced from the others. There's no real linkage. And that's because of the size of the Henry Hub market. So the takeaway from this is LNG pricing is increasingly global for these short-term indexes. But you can get very short-term sort of discontinuities, if you like this spike up here, which was, well, we'll go on to the next chart, see that in more detail. So this is looking at a shorter time frame here, so 2018 through to now, basically. So you've got those three curves again. You can see Henry Hub is this green one. It's very, very consistent. There was a bit of an uptick. That's Ukraine here. So it goes up, but not really, not very much. Whereas the other ones just went absolutely crazy at that point, and they went crazy together. So they really were locked up. There are some differences in there, which are due to logistics and that sort of thing. But basically, these index just went through the roof. You can see the initial COVID impacts here. If we run, when COVID was March 2020, to right in here, the spot price went down to well below $2. It was as low as I've ever seen it, and at this point, it felt like the prices were going to stay that way for quite some time. But the exact opposite happened, and both the European price and the Asian price spiked up during COVID, and then of course Ukraine happened. So it was sort of a double whammy, if you like, that caused both of these indexes to spike to unprecedentedly high levels. And a problem with this is it really tends to undermine your confidence in these indexes. Because if for instance, you were a buyer of this commodity, and this is happening, you know, it would be very difficult for you to commit to that commodity, because this might happen, you know, at some point. So it undermined the confidence in the spot market, and relying on the spot market and people back to long-term contracting, which I showed earlier. But long-term contracting is actually either stable or getting more, you know, is actually increasing, which, you know, generally as commodity markets evolve, they actually get shorter term and use the spot market more. But in this case, you know, because of what's happened, this is there really has been people have a concern about committing to this, and I don't blame them. I don't think it would be the right thing to do to commit to the spot market, given what we've seen here. So those are the gas indexes, and then you relate those. What do they mean to as far as oil price is concerned? There's quite a simple energy parity calculation you can do. It's not 100% accurate, but it's pretty good. And yeah, that's why you basically divide the oil price by 6 or 5.6 or somewhere between 5.6 and 6, and that gives you the gas price. And all these things have slightly different energy contents and that sort of thing. So it's not precise, but it's roughly the case. So at $60 a barrel of oil, you divide by 6, you're at $10 a million British thermal units for the gas price. And that's then called the slope, 16 to 17.5. And the slope is just the it's the percentage number you multiply the oil price by to get the gas price. They tend to be at a discount to oil because, you know, LNG is just more difficult to deal with, more difficult to move. It's more expensive to use, so there's generally a discount to oil. So that's why, you know, the traditional pricing of LNG was not about 16.6 to 17 slope, it was more like 14 or something like that. This is actually, you know, not the easiest chart in the world to interpret, but what it's trying to show is that, you know, these flat lines are the sort of slopes that long-term contracts would be at. And the jagged line is the spot price. So again, you could see that when the spot price spiked over here during the Ukraine situation, LNG became much more expensive on a thermal basis, if you like, than liquid fuels, diesel or fuel oil. So and you did see this happen. You saw people not stopping using LNG and going back to diesel. And that's because it was more expensive to burn LNG, given the amount of heat you got out of the burning the product. So this sort of variability, you know, leaves everyone with a dilemma, because even as a seller, as I was, this is not good. You may look at that and think, well, the price has spiked up. That must be great for the sellers, but it really isn't. It's never good when the product you're trying to sell is so unstable in terms of price, because it just deters people from buying it in the longer term. This is not good for this sort of volatility. Is not good for anyone. And you have I've called their buyer's dilemma and seller's dilemma. The buyer's dilemma is that at these very low prices down here, again, they feel good for buyers, but it means there's no new supply will not be brought on, and eventually you're going to go into a spike. And the seller's dilemma is these very high prices deter the use of your product. which is not what you want to be happening. So there is no real perfect answer to this. The industry just tends to go through these booms and busts, but they've not in the past been as stark as they were during the Ukraine situation. That's been particularly bad. Quickly talk about how oil link pricing works. It's pretty simple in that you look at the oil price and you multiply by a factor and come up with the gas price. Now that's sort of a simple way of putting it, and people, as creative as they often are, will come up with different ways to customize the particular deal. So one of those is things like what's called S-curves. So you can see the S shape of that curve. So all that's doing is, as the oil price moves into more extreme areas, the price sort of moderates in terms of how it changes. And they can go all the way to floors and ceilings and those sorts of things. You know, lots of ways you can negotiate these things. That example up there is, you know, 15% slope S-curve. So the way you'd work out the gas price is just down here. So $100, it's around about in the middle. It's just 0.15 times 100 plus what is called the constant, which is where that line crosses the axis. If you know, when you do sort of 20-year deals, they're not fixed for the 20 years. There'll be some form of review process. So something called a price review. Usually every 3 to 5 years, that this arrangement will be reviewed. That is, it's almost the definition of a zero-sum negotiation, because at that point you are locked together. You can't really walk away from each other. You have to come to an agreement, and that can make those negotiations really quite difficult, and they tend to take a long time. But there is no alternative really. You can't, otherwise you get stuck for, you know, potentially 20 years in a pricing arrangement that is not close to the market. But one final point I'd make is almost everything is negotiable in these deals, regardless of what somebody might tell you. So this was, you know, the view was this was going out of fashion, but it really hasn't. It's back with a vengeance. So before I go on to that, so if you look at that 15% slope, that's just an example. So if you look at where have those slopes been for the last decade, and you can see, you know, this is 2012. You know, they were in the sort of 14. This was the end of that Australian boom I mentioned, and they really started to decline pretty much all the way through to COVID. Slowly declining down, and they got down to about 10 point something, 10.5 maybe. And then there was a post-COVID spike in these negotiations as well. One thing about this is there aren't actually that many deals done. You know, it's not like there's a deal every day. So the granularity of the data is not always that good, plus they're all confidential. But after the COVID spike that took it back up into the 13s, things have really dropped back down again. And this is looking at that potential very large wave of new projects coming on in sort of 27, 28. So that's the US projects and the Qatari projects, which are going to bring a lot of new volume on. So I said, you know, the current situation is downward pressure on pricing. So the question is, where's it going to go? Going to go down here somewhere. And what that means for an importer, such as the Philippines or others, is if you think about what the volatility of the spot market, you know, one way to mitigate that is you enter into a longer term contract with oil link pricing. That will damp down the volatility. There'll still be some, because the oil price itself will be volatile, but it will be much less than we've seen in the spot indexes. So the bottom line is now is a good time to be doing that, and expect these pricing levels to continue to drop down. The Japan-Korea market, so this is the spot price. There are a number of ways these sort of prices are developed. Some of them run through exchanges, sort of automated exchanges, where prices are determined electronically on a sort of buy-sell type arrangement. JKM is not like that. There just isn't the volume. People have tried to set up things like that for LNG. They've not really worked. There aren't enough trades going through, and they're all a bit different. So the way JKM is worked out is that the company that does it really just brings in data from the market. There's something of a ring around in some ways. They just call around, what are you selling this for? And so on. And they collate all that data, and then they do a determination of what the pricing is. Sort of 2 weeks out, 4 weeks out, 6 weeks out, and so on. So it's a very sort of not primitive process, but it's not an automated process in any way. There's a lot of subjectivity you can go into it, put it that way. But it's actually the spot price for any cargo delivered into Japan, Korea, China, or Taiwan. You can see there are certain restrictions on aspects of the cargo that can be considered, how big it is, what quality it is, that sort of thing. And it excludes some cargoes, like Russian cargoes, don't go into it. It was introduced by Platts in 2009. If you're a company like Platts, getting to the point where you provide the market pricing data is a very big win for them. There were a lot of different indexes running around trying to become the de facto industry standard. There was one down in Singapore called Sling. That's now been cancelled. And I think JKM will now be the LNG spot price in Asia going forward. The other issue is not all participants report to Platt. They won't tell them. I know companies I work for wouldn't talk to, because you open yourself up to sort of market manipulation accusations, even if that's not what you're trying to do. So it's easier just to disengage. So it sort of has some problems, but it's the best we've got, and it will continue to develop, I think. There are futures available, which is this is something that allows you to manage risk out into the future. These other indexes have, like Henry Hub, which is very well developed, has very long-term futures. So you can buy Henry Hub 2 years in the future. You can, in theory, for JPM, but it's not really very easy that far out. So 9 months, 12 months is not bad. And it is getting better. So this is what determines the spot price in Asia. The alternative, the equivalent in Europe, and there are a number of them around the continent, but TTF seems to be emerging as the most used. Is TTF stands for Tidal Transfer Facility. So that's a point in the Netherlands set up by Gas Unie, and it's in euros. It is actually traded on an exchange, ICE, which is International Commercial Exchange, I think. And it has some other idiosyncrasies to it as well. But it was severely impacted by the Ukraine crisis. It really went up very, very dramatically, as you saw in those earlier slides. But that's the European equivalent JKM. A bit more developed, more liquid, better futures. And that's because this is an integrated, not a completely integrated system, but largely you've got a pipeline network, which if you've just got ships going between regas terminals, you don't have. And then the other end of the spectrum is the US, which is a completely developed network of gas pipelines, production facilities. This is extremely integrated. And Henry Hub itself is right here. This is a place called, what is it? physically where it is. I think it's a place called Erath or something like that in Louisiana. So it's actually a specific point, a series of pipes and junctions and so on. And what that gives to you is a point at which you can price gas throughout the network. And it's very heavily traded on exchanges like ICE and NYMEX, which is the New York Mercantile Exchange. And you can get hedging, you can hedge it. You've got other risk management tools. So it's sort of the opposite end to JPM. There are a whole range of other index prices in the US as well. And that's, that map just has some of them. And they also have differentials between them, which are really driven by pipeline costs, transportation, and so on. So when you see in the press, for instance, just using oil as an analogy, that I think during COVID, there was, you read press reports, price of oil goes negative. They're giving it away. What that really was oil here. Well, oil here price was depressed. So when you took away the transportation cost, it went negative there. And something similar sort of things happen with gas. So those sort of things don't really reflect reality, but they're just they happen because of the transportation constraints. And that's certainly true that some of it, like this one is called ACO, I think it is. That's very often extremely depressed, as is the one up in Canada, because they're just in the middle of nowhere. If you do a US LNG project, how do you price it? And it's completely different from the other ones. What you do, FOB means free on board, so that's at the outlet of the LNG plant in the US Gulf Coast. What you do, you take the Henry Hub price and you multiply it by a percentage to be negotiated, and you add a constant. And that percentage over time has been anywhere from 110 to 118. And what that pays for is fuel and transportation to get the gas to the plant, wherever it is. And again, it's negotiable. And the constant is somewhere between 2 and 350. I think it has actually been below 2. I'll show a chart later showing how that's changed over time. That's probably the key area of negotiation. You spend a great deal of time working this out. And this is what gives the project developer their return. They have to get enough there to pay to build the plant, pay back the financing, pay the operating costs, and so on. Part of it will be escalated at consumer price index part 1. Maybe we'll go to toll agreements. One of the advantages this sort of arrangement can give, say, a producer of gas in the US is that if you're producing gas in the US, we saw the very low price you get for it. You don't get very much. If you do this, it gives you access to international markets that you wouldn't have access to otherwise. Now, it costs you to do it, but it gives you that alternative that you could go and sell this on a price. And that sounds like a good thing to do until everything switches around and you find that you're actually now selling it for less and you could sell it more in the US. So that sort of arbitrage between the two pricing levels can be very, very significant, and you can run into sort of accounting type losses in the billions of dollars very, very quickly if you get on the wrong side of this sort of transaction, because they generally tend to be quite long transactions, so they have quite a lot of volume in them. And from an accounting perspective, you have to look at all of them, so you can find yourself with very significant write-offs if you get on the wrong side of that. And that's happened to a number of companies over the years. And I'm not sure whether it was a surprise to them or not, but it can have some very severe consequences. And the tools to, traditional way to manage that would be you'd hedge it somehow. But the tools are not really there. I mentioned the risk management tools for JPM, not really there for the longer term. From this, shipping to Asia from the US is around about 2.5 times more than, say, from Australia. So there is an increase in shipping costs. The other very useful feature of these, I think I mentioned this earlier, is to cancel your cargo. So I think I'll maybe go on to that. I'll talk about that now. So this is the build-up. This is what happened during COVID. The value of LNG was negative, or not negative, it was below what it cost you to produce it. So you're actually losing cash on every cargo. So what everybody did at that point was just cancel them, just pay the fee. And that was a strategy that obviously lots of people did. And but we actually never seen that before in the LNG industry. It's but very quickly during COVID, pricing recovered and all the volume recovered. But it's unique to the US. So if we just go back to this constant I mentioned, which is the main area of negotiation, what's it been doing? That's sort of where it's been over the last 8 years or so. And if you go back, it actually went up as high as 350, maybe a little more than that at one point. But it's generally in the twos somewhere now. And it has been going up as construction costs go up. And construction costs have gone up because of demand and also because of interest rates have quite a significant impact on the cost of building these sorts of projects. So you're seeing after the these being fairly flat, they're actually starting to go up again. If the sort of question, which is best, which pricing should you really go for? And there's no right answer to it, they're just different. So, how they're different, if you just look at, say LNG delivered here, which would be better? And what it is that Henry Hub is just less volatile. So, as oil price goes from 20 to 140 here, the Henry Hub price doesn't really change. Well, it does change, but not as much as the oil one does. The oil price just changes more. So at low oil prices, you're better off with an oil link. At high oil prices, you're better off with a Henry Hub link. Now, there's a lot of negotiable things in that, obviously, but in general terms, that's the difference between the two. Henry Hub has a much bigger fixed component in the price and therefore moves around less. And so this sort of illustrates the dilemma I know I had when I was working in a company dealing with this, is that when the oil price is low, you'll be explaining endlessly why you've chosen this one, not that one. And when the oil price is high, you'll be explaining the opposite thing. You're just constantly having to be prepared to explain why there's a different way of pricing this, which would be better. Because over the life of these contracts, you're always going to be on the wrong side of this at some point. There'll always be a better deal somewhere else that you could have got. So you have to look at the long term. You have to look at things on averages, and rather than just look at any one point in time. I could have got a better price if I'd done something differently. Talk about that. I'm actually not going to focus on this one. This is the one I've mentioned around Japan average price. So this is the Japanese government publishes customs data where it looks at for a given month how much gas or how much oil has been delivered into the country and how much money has been paid for it. And if you divide those two things by each other, you end up with an average price, either for oil or a variety of products or natural gas. Now that number is very often used, the oil number is very often used to price oil contracts. You can do the same with gas, and this has been done. It's not that common, but it has been done, and one of the positive things about this is you don't have to have a price review. You just put it in place, and it's a bit like an ETF tracker fund, if you like, in terms of what it's doing. It's just using the index, and you're getting the average. If you look at spot versus term, now when we looked at earlier, spot versus oil linked, those last few years during Ukraine, it was very clear that spot was bad. Those big spikes we saw. But if you step back a little bit and look at longer term time periods, which was better, spot or term? And again, with thanks to Shell on this one, they've plotted, when was spot better than term and vice versa. And you can see it's actually sort of swings and roundabouts. Sometimes it's better with spot, sometimes it's better with term, that's sort of the way it's been. If I had to say, it feels like over the years the spot has probably been a bit lower on average until recently, but if you look at it a long enough period, it kind of equalizes out. One of the questions is, what's the proportion of volume actually sold on short-term or spot contracts? And it can be quite difficult to work that out because everything's confidential, but there are other reasons as well. Because not all deals that look like short-term really are. They saw a number like 30%. Maybe if volume goes through on short-term deals, spot deals, and then the rest is sort of on longer-term arrangements. And that's the same chart, just with a different data set running through, showing that one shows that somewhere between 30 and 40% of the total is sold in the short-term market. But not all short-term deals are linked to gas indexes, so that can change as well. We look at things you have to think about when you're contracting. I'll run through this quickly because I'm not sure anyone here is really going to be contracting. But of the various types of agreement, we talked about the long-term sale and purchase agreement, master agreement, which is the simpler one, and then standalone contract. You have to think about things like, how long do you get to make it, duration? Are you going to tender it? Are you going to do a bilateral negotiation? Are you going to tender and then shortlist? What pricing do you want? So you've got all those options in terms of price, which will give you very clear outcomes. Are you going to pick it up in a ship? Do you want it delivered to you? Those sorts of things. And there are many others. A number of sort of key terms that you have to determine in the agreement. And you've got to go through and pick which ones you're going to use depending on your circumstances. And so that's just an example of, and that's not specifically it's just one way of doing it. Is if you've got long enough, if you want the gas for 2 to 10 years, you'd probably do a long-term contract. You might tender it because you had to, and you might decide you want it delivered. You don't want to get involved in shipping. But the complexity of this table, and generally, there are a lot more terms as well off on the right-hand side you could use. It's one of the reasons that it's quite difficult to use tenders, because when you tender something, you have to really have pretty clear requirements, and that limits the amount of sort of negotiation and customization you can do. One issue that is always the subject of intense negotiation is flexibility. In that the seller doesn't want to give you very much, and if you're a buyer, you want to get as much as possible. And I won't go through all the terms in detail, but you have to define generally these long-term deals are done on an annual basis. So you have to define how much gas you're going to take in a year, and then you get some flexibility within that, but you have to really determine a year ahead how much gas you want. That's one of the reasons this is quite difficult if you've got an FSRU, where you've got very, very limited storage. It can be quite difficult to get the timing right a year ahead. That's a difficult thing